This is the Service Learning Project for a Tax 2 class. They're going to talk to you about a variety of items of benefit for college students.
The first thing we're going to talk about is interest on student loans. This is a deduction for AGI, which is your adjusted gross income. It's on line 33 of the 1040. The maximum deduction is $2,500. It's being phased out beginning 2013 if you have an income over $60,000 and $75,000 and 125 to 155 if you're filing joint. This is a deduction not allowed for taxpayers claimed as dependents or married filing separately. The next thing we're going to talk about is the American Opportunity Credit. This is for books and other course material. There's two credits. It's the American Opportunity and the Lifetime Learning. The American Opportunity is on Form 8863. It's line 49 on the 1040. This is for books and other course material. It's not for room and board. It's $2,500 per year. It's 100% of the first $2,000 and then 25% of the next $2,000 for 4 years. Lifetime learning is usually for students who are going past 4 years of education. So like if you get your bachelor's from Globe and decide you want to go on to your master's, this is what you would use. It's 20% of qualifying expenses up to $10,000 per year in a year in which the American Opportunities Credit is not used. The eligible people are the taxpayer, taxpayer's spouse, and taxpayer's dependent. To be eligible for the AOC, you must be taking at least 1/2 full-time course credit at a qualifying institution, and there is no requirement for the lifetime learning. The income limitations are $80,000 for single and $160,000 for joint, and it's eliminated at $90,000, $180,000 for joint, and the lifetime phase out is $53,000 and $107,000 for joint. If you happen to graduate and get a job and you want to continue on with your education, you can, but there's certain things that you need to do to be able to claim education deductions. In order to claim them, it needs to maintain or improve existing skills required in your job, or it needs to meet express requirements of the employer or requirements imposed by law to retain your employment. You cannot deduct if you're just going to start a new trade or business or to meet minimum educational standards for the job. If you're a teacher, unfortunately the teachers here can't deduct expenses, but if you work in elementary or secondary teachers, they can claim $250 per year, but they must work 900 hours in that year.
The next topic we're going to discuss is qualified tuition reduction plan, and that only applies to employees working in an educational institution like Globe University. If you are provided with tuition, free tuition for your dependents, for your spouse, for yourself, if this is included in your wages, then it's considered income, and you'd have to put it on your 1040 line 7 or line 1 of your 1040 EC. Now, if this is a benefit that's not included in your wages, then it's completely free. You wouldn't have to include it as income, and it would avoid increasing your adjusted gross income. Now, this is a Coverdell ESA, which is also known as Education IRA. That's what it was called before. And this is basically a savings account that you could open up for your children. Your maximum allowable amount is $2,000 per year. Now, this will be considered as part of your income, even though you'll be saving it. What is not included as income is any interest that you receive from that savings account. But once you do withdraw it, you still can be eligible for any other educational expenses that the money was used for. So basically, this covers any double booking of benefits. So if it was eligible to not to be included in your adjusted gross income, then you couldn't later expenses as a tax deduction. You can withdraw it until your child is age 30 and still continuing education, and you can contribute to the savings account until the child is 18. And the next is the IRA distribution. If you're lucky enough to have an IRA account, you can make premature withdrawals towards an educational expense to a qualified higher education. Basically, that's college level or higher. The penalty for withdrawing will be raised, but it is recognized as income, and again, that income can be expensed as an educational expense. Okay, qualified tuition related expenses. This applies for everyone. It's taking higher education. Your maximum deductible amount is $4,000, and it's based on a maximum of $65,000 for single, and married filing jointly $130,000. Your max deductible is $4,000 for the year. If you are making over that amount and are between $65,000 and $80,000 per year income for single, or $130,000 to $160,000 per year married, your maximum allowable amount is $2,000, which means anything over the 65 to 80, it's sort of phased out. This does not include room and board. It's only for educational expenses, tuition, and books. This does avoid the 2% floor that you'd have to prove in order to do the itemized deduction.
The next item is talking about scholarships. The money that somebody else gives it to you, it's not counted as income. So, but if you use it for like room and boarding, then that income is counted as, that money is counted as income, and you'll have to report it. Another one is a qualified tuition program. It's pretty much your employer pays for your schooling, for your tuition, and they can contribute up to $52.50 a year, and that money is not taxed, and the employer doesn't get taxed on it. The next one is a savings bond. It's a Series E U.S. government bond. The interest that earns it, it's not taxable. So whatever interest you earn is not taxed, and it's for if you're 24 or older. And the next one is 529 plan. It's also the interest that it earns is also not included in your income, so you don't have to report it. And it has to be used for higher education expenses like books, tuition, but not room and boarding.
That I forget the name of it, but the educational savings account is it for dependents?
The Cordell,
Yeah.
you can save $2,000 a year. Your children have to be under the age of 18. It's still considered income, but you can save it. Now, if you do get interest on that savings account, then that will not be included in your income.
Does it have to be for your children? Like, can grandparents do it for grandchildren?
I think it's basically for the parents. I believe it's owned solely for the parents, not for the grandparents.
Could you talk for a second about the difference between a tax deduction and a tax credit?
A tax deduction would be a deduction from your income. It would decrease your adjusted gross income, and a tax deduction would decrease your tax liability. So instead of having to pay $4,000 towards your taxes, maybe you have an expense and a credit, and maybe now you only have responsible for paying $3,000, example.